Hello everyone, hope you all are doing well and had a great trading week this week. In this video, I will be discussing the concept of an imbalance. Now this is something that we don't talk about too often on the Aerial FX YouTube, but is a vital component of our smart money strategy. So I figured I'd make a video for you all today solely going over imbalances. So it doesn't matter if you're completely new to what an imbalance is or you already have a clear understanding of how to use it as a part of the smart money strategy. I will break it down from top to bottom, giving you a basic overview and then divulging into more complex examples of how we can utilize imbalances in our everyday smart money trading. So first we have to identify what an imbalance is and why it forms. So I'm going to draw up here a consolidated block. Oftentimes when imbalances are created, they are stemmed from very volatile moves. Okay, so there's liquidity, and it's not going to look this perfect, guys, every time, but here's just an example. So let's just say there is some form of sponsored candle here or some sort of supply level that we have come into with this move, and that's why we had the reaction short, right? So oftentimes when price sweeps liquidity, it does so very strongly, very quickly. So it will sweep the liquidity and then push in the opposite direction or the overall direction of trend very violently, coming up into a level of supply or a sponsored move of some kind. So when price does this, the banks have to move price very quickly and then get in and get out. So this creates strong and a lot of volatility. And what an imbalance is a skip of liquidity. So it kind of looks something like this. If I draw, oops, let me go back here. If I draw some sort of, actually I'm going to make it green. A green candle, right? This is the candle that pushed up into this supply zone. And I'm not an artist, so just bear with me here. And then a red engulfing candle. So we have the reaction from that level, and price moves very strongly. Maybe we have some sort of mini doji candle here that kind of retests, and then another engulfing candle. Well, what this does, and if we can continue to push down, I know this is a different color, but when price continues to push down, starts to pull back a little bit, chops around, it creates an imbalance. So what an imbalance is a skip of liquidity. So right here, between this wick, and let's just say there's a wick on this candle here, and this wick here, right? Between here and here is straight selling, right? There's no buying that's offered in this region of price. Because to make the market efficient, we have to come back up and fill that imbalance to offer buys in this region where it was only allotted sells. Because we can see between this wick and this wick, it's just straight selling, right? Now there's also more imbalance between maybe this wick and obviously this wick here. So there's a little bit more imbalance that could be filled. So oftentimes what price will do is it will come up when upon a pullback, fill the imbalance. There could be more up to the upside, something like this, and then continue in the overall direction, offering buys within this region of price because we know that it was just straight selling volume, straight selling in here. We pulled back, create some sort of wick, whatever, and now it creates that imbalance. So when price moves very strongly, it skips liquidity. It doesn't offer or make fully efficient both a buy and a sell at that current price. So in order to do so, we have to rebalance the market or fill the inefficiency. So an imbalance is the same thing as an inefficiency, same thing as, I know a lot of people know what a fair value gap is, sell side inefficiency, buy side inefficiency. There's so many different terms for it. But essentially what it is just repricing or making the buys and the sells the same. So if we come back up, we will be offering buys within this region of price that initially only allowed sells. Same thing in here, we engulfed, only sells were offered in this region of price. In here, buys were offered. And between this wick and this wick, we already filled it because we sold, only sells were offered, we filled, we offered buys, and then we continued and engulfed. And maybe we saw another engulfing candle of some kind, right? That created liquidity. excuse me, that created the imbalance. So we only offered sells within this region and in this region. So we have to come back up and make the market efficient. Now, how does that help us as smart money traders? Well, obviously, you have to understand that all these concepts that we go over, and especially imbalances, you have to put them all together to form that holistic understanding of smart money, that entire strategy, if you will. So you can't just trade imbalances on its own. Sure, you may get lucky on occasion because it might fit the entire smart money overview, but it is very important and crucial that you use imbalances with other confluences as well. All right, so now that we know what an imbalance is, why it forms, and how it gets filled, how can we take advantage of an imbalance in everyday trading? All right, so I'm going to get rid of all these drawings and we're going to go into a few examples here. Now, there are two ways in which we can trade imbalances. There is something that I like to call the full fill and then the mean threshold fill. I'm going to go over both in this video, but I'm going to first talk about the full fill. So we can see here on NZD/USD, we are very bearish. Higher time frame, we're making lower lows and lower highs. All right, now we have to understand all the concepts within smart money before even taking a trade that has anything to do with an imbalance. So on a very broad level, higher high, higher low, higher high, higher low, higher high, higher low. We have failed to make a higher high in the sequence, and then we broke and closed below the previous market structure, creating that lower low. Now we're starting to trickle back up because now that we have closed below this level, we can consider this a continuation in the bearish trend, whereas this was simply just the pullback waiting to end. So we have finally broken structure here. Now we're awaiting a pullback to continue short with the overall bearish trend in the market. Okay, so now that we have market structure on our side, how can we incorporate liquidity, imbalances, time and price, all that good stuff into our trading? Well, we can see here, we pushed up, we pushed down, we made a higher high, higher low. We made, I wouldn't say a higher high, we kind of failed to make a higher high here, and then we rolled over to the downside, making a lower low. This was our last buying volume, or really this wasn't here before a very strong move occurred. There was only buying offered right here and in these wicks. There was no buying offered within these bodies of the candle, right? So we have to make the market efficient. And oftentimes it will come up and make the market efficient before continuing in the overall direction. Not all the time will it fill an imbalance in its entirety, but over time, imbalances do get filled. We have to rebalance the market and offer, in this case, buys in these regions of price that have not been offered yet. So we can see when we made this high here, we started to fall. The imbalance was really between this wick and this wick here because everything is efficient in here. We have been making ourselves efficient. We have offered buys in here. We pushed up, we fell, pushed up a little bit. We've been offering buys. The inefficiencies have been completely filled in here. And then all of a sudden, engulfing candle. So now we have an imbalance. We continue, another engulfing, another engulfing, another engulfing. So there's a lot of imbalance that has been taking place here. So oftentimes we can understand that this was the start of where the imbalance formed, and especially because this was our last buy to sell when we broke counter trend structure, we can see that from the high to the low, this is a 71% fill, so fib level. So we're in premium price because we want to be selling at premiums, not at discounts. We can align our trade around this imbalanced move because it has all the other concepts associated with it. We have build confluence. So in this case, the full fill of the imbalance was right at that price, 63265. We have come up our last push to the upside, filled that imbalance, and now we can make another move to the downside. Same thing kind of goes here. When we pushed up, this was our last buying volume before the overall sell-off. Now we can see we're starting to create a low. We failed to make a higher high, and then we made a lower low, lower high, lower low. We pulled back up, and we can see that there was imbalance in here between this wick and this wick. There's just straight selling. There was no buying offered. So that's exactly what price did. We came up to the full fill of that imbalance, we filled it, and then we rallied back to the downside to continue. We've made the market efficient, and now we're pushing back to the downside. All right, so that's just an easy example of how to utilize imbalances in your trading. And they happen everywhere, but the key thing is you have to put them in conjunction with other confluences that's a part of your strategy. Now, we teach a very specific smart money strategy, so yours may be a little different, but you have to build confluence and follow your rules when trading, and not just trading using an imbalance. There are imbalances everywhere. Does this mean that you should be placing a trade right here off of a buy? This is imbalance between this wick and this wick. It filled it, sure, but then it just continued. Doesn't mean you want to be looking for a buy here. There's imbalances everywhere, but you have to understand which ones are the most important, the highest probable. Now we can see here again, as we were pulling back, we're making higher highs and higher lows, right? Higher high, higher low, higher high. We were making a higher low. We should naturally expect a higher high. I know we rolled over because the pullback has now finished, but even so, we reacted here and we're pushing back up, right? So just following market structure. Now, where was the imbalance here? Now, there are tons of areas of imbalance. There's imbalance between this wick and this wick. There's imbalance between this wick and this wick. There's imbalance probably between this wick here and this wick here. Which one is the proper imbalance? Well, it all stems down to, again, adding other confluences. Well, we have to get down into discount. We don't want to be buying at premium price. We want lower prices in the pullback sequence. So higher high, higher low, we want to at least come below the 50%. So that automatically eliminates this imbalance. We want to come down into a level of where we swept liquidity, so some form of demand zone. So this overall would be the demand zone, eliminating this imbalance. So now getting further down into it, where can we be looking for a trade? Well, we can see that this candle here probably filled some sort of imbalance here, maybe attached itself or mitigated some sort of sponsored move, because what is a wick? A wick is, in this case, selling and buying at the same time. So some sort of sell to buy that mitigated this demand. So that's probably what we did here. And if I use bar replay really fast, I might be able to find it. Yeah, so something in here, the sell to buy, we came down and mitigated, right? So going back to the hourly time frame, we can see that now this becomes, we've made a lower low, a lower high. We failed to make that lower low, and then we mooned and made that higher high, right? So this is our last sell to buy move in the sequence. And we also can see sells were offered in here, then buys were offered, but no sells were offered between this wick and this wick. Sells were offered in here, but didn't completely fill that imbalance. So where do we place the trade? Well, now there's two ways of trading this. In this case, you could do the mean threshold. The mean threshold is essentially the 50%. And either an imbalance is filled 50% of the way or it's entirely filled. So in this case, I would have easily just put my entry right at the full fill there. You could have done 50%, but it's only a matter of a pip or so. And we can see the accuracy that price has come into, really pretty much to the T, little to no drawdown at all, pushing down very strongly, but then reacting because we made the market efficient and we pushed back to the upside. Also, where is this? Where is this imbalance located? I'm gonna get rid of these drawings here so we can make it more pretty. Sorry guys, here we go. I'm gonna redraw that. Where does this imbalance line up? Now, I drew this at 6270, and it's not the entire fill of the imbalance, and that's okay because this is a psychological level. Again, we have to use other confluences. Psychological level are highly sensitive regions of price where a lot of the orders are placed or filled at. So 62700 is a round figure, a psych level. It's very close to that imbalance. That's where I would have placed my entry. Sure, you could have done 62695. That's okay. That's the full fill. But you may not have gotten the fill because of the spread. But oh well, you can just see the accuracy that played into that particular trade. And obviously, we should have had the notion that it was going higher because of just the sequence of price. However, based upon other market confluences within smart money, you would know that this is a level of supply that we did fill higher time frame, which is why we didn't make that higher high and we actually broke and made a lower low. That's what we were expecting anyways. But that's how we could trade an imbalance. Now going to another example, I'm going to go to USD CAD, and this is, I believe, July 1st. Let's see. July 1st. I know I had the example. There it is right here. Sorry, I just couldn't see it. So now, USD CAD, we are very bullish. Higher time frame, we're making higher highs, higher lows. But while we were trading in here, we could assume that because we made a low and we failed to make a higher high, and we actually made a lower low, that we would pull back and make another lower low again to come deeper into our demand level to have a deeper, higher time frame pullback. Because sometimes this lower time frame trend, or really what it is just simply a higher time frame pullback for another expansionary leg. All right. Well, we never pushed back down into here, but you would have expected that upon the second break of structure. So we had one push up, higher high, higher low, failed to make that higher high. We stopped, then made a lower low. So we would naturally expect a lower high and a lower low. So now that we know where market structure is, let's look for our other confluences for taking a short trade. Well, we can see here that this is our last buying volume. The counter trend, high, low, high, low, high, low. We reacted off of demand. This is an area of demand because this is high, higher, low that reacted from a prior higher low, but we failed to make that higher high and we rolled over to the downside. So now this prior demand flips to supply, and look what else we had. While we broke that structure to the downside, we not only swept liquidity very quickly, but then ran to the downside very quickly, this engulfing candle. And we can just see the size of this move. Only sells were offered within this candle. Now between this wick here and this wick here, only sells were offered. There were no buys that were offered. Buys were offered in here because we can see the up close, but then we push right back to the downside and we push down, right? No buys were offered within this region of price. So how do we make the market efficient? Well, we understand liquidity was run, break of counter trend structure, demand was now flipped to supply. We're bearish now, looking for an overall higher time frame pullback. So we should be looking for a pullback to short. So, and then we created the imbalance. So now our entry really should be anywhere in here. Now, you could take it off of the 50%, the mean threshold. That would be appropriate. Sometimes it just comes to the 50%, especially with strong, huge moves like this. In this case, we did come and hit the full fill, and that's okay. You know, obviously our stops wouldn't be right here upon the 50% of the fill. We would place it above the supply zone. That's why you have to have other knowledge of smart money while trading imbalances as well. But you could have placed your entry here or at the full fill before we started the imbalance move. Okay, so if you did that, you would have had just maybe a few pips of drawdown. But anyways, we made the market efficient again. So now we can continue with the overall direction of trend. In this case, short. I know that we pushed right back to the upside, but if you still hadn't taken this trade, you would have made a good amount of pips anyways. Okay, so that's another example of how we can utilize imbalances. Now we can see here clearly there's a lot of imbalance with this. So we're looking at filling that imbalance. I would not be surprised if price came down, took liquidity here because we have equal lows, and filled more of this imbalance. Higher high, higher low. This is the low that made this high because this high was not produced off of this low. It was, but it wasn't. It was because obviously we can see it did, but at the same time, we never closed above this level. We wicked above it, but we never closed above it. So that does not necessitate or make necessary a higher high, right? So we finally closed above it now. So where's the range? The range is right here between this low to this high. So we can see an overall pullback. A closure below this level would not insinuate a break of structure. It would just be a liquidity run, in my opinion, to then come higher, filling a lot more of this imbalance in here. And we can see there's tons of imbalance. So that would be my region of price in which I would be looking for a trade from, probably somewhere around 1.29. psychological level, maybe 2890, 50% of it, or the full fill if we can get all the way back down. When strong moves like this happen, oftentimes you don't see huge retracements into the imbalance. So you have to kind of take it how it is and say, okay, well, maybe on the higher time frame, there's higher time frame imbalance. Like right here, there's sells offered in this region of price before we move back up. There are sells offered in this region of price, then there were only buys offered. So the imbalance could be technically from here to here on the higher time frame. So we probably want to be looking for buys in this region of price. Imbalance, also that would be that liquidity run on a lower time frame if we just scale in, right? So somewhere in here. So that could be, again, 1.29 for that full fill, 1.291, 1.292, but so somewhere in that region, especially because it's at discounted levels before continuing long. So that's something that I would look for the week ahead. Now, my last example is a really good example, and it goes over how we can properly utilize the fair value gap. Now, this happened a long time ago. I remember trading this. This was back in 2020 during COVID. And it was all the way over here, but it was such a really good example of a fair value gap, inefficiency, imbalance trade, whatever you guys want to call it. All right, so now we're going to go to a lower time frame. I'm going to use bar replay, and we're just going to put it there, and we're going to go to the 1 hour time frame. Okay, so now in here, I'm just going to zoom out. I know it's blurry, but I'm zoomed out. Just from the look of this, what can we say about what's going on here? Some people may say, oh, we're just consolidating. Sure. Some people may say, oh, we swept liquidity here, had a sell to buy, made a higher high. And, that's the case. But some people may say, oh, well, we swept liquidity, sell to buy, made a higher high, and we have imbalance. We do have imbalance. We have imbalance right in here. There's an imbalance move. And really this sponsored move, sell to buy. There's only buying offered between the selling point here and right in here with that wick, imbalance. And it happens to line up with the sponsored move, which is why we came down into it. But at the same time, there are more areas of imbalance. So let's just say that we did react off that. But now we created another imbalance. So we swept all this liquidity. We had a sell to buy, broke counter trend structure, right? We came into a sponsored move. Now we created more imbalance between this wick and this wick here. So oftentimes, well, most of the time, we will come down and fill that. And when it's a very small imbalance like this, I usually just go the full fill. I don't really care about the 50%. We have that 1, 2, 3 pin pattern here, so that full fill would be nice. And we can see that that full fill was filled. We had maybe a few pips of drawdown, but nonetheless, we made the market efficient again, and we continued to push higher. We ended up coming back down a little bit lower, but the stops would have been below here, and you would have been fine. Just happened to be one last liquidity run. Could have been an imbalance fill in here on a lower time frame, right? So that's something to think about as well. Now, another example is in here when we expanded and we broke the counter trend structure to the upside, right? We closed above because initially we were pulling back to mitigate this level, which we did. Then we broke the counter trend structure in here, right? Lower low, lower high, lower low, lower high, lower low, higher high. We broke above it. Now we pulled back to mitigate and filled the imbalance right here. Imbalance was filled and we expanded. Stops below the low. So now price has made a high, has failed to make a lower low as expected, and now we've made the higher high. So now when we have these strong moves, and I mean very strong, it is huge, could be hundreds of pips. In this case, it was about 100 pips, but a very large move. We don't really want to be paying too much attention to these tiny little imbalances down here, or like right in here. Now, if we were trading within here, right, if this was the move and we were coming back down, then yeah, that imbalance would probably be very valid. But since this was a very strong move with a series of bullish candles, we can zoom out a little bit and see where the imbalance is on a higher time frame. So now that we've broken counter trend structure here to the upside, we are bullish. Where is the imbalance? Well, many people would say, well, it's from here to here. Sure, that is, but This is a very small imbalance when it comes down to the big move. And we have to just use a little bit of common sense here when trying to trade imbalances. But the real imbalance is from this wick to this wick. Excuse me, this wick here. I'm sorry, because sells were offered in here. This wick and this wick. Only buys were offered in this region of price, right? So we have to come down and make the market efficient again. So where is the appropriate level to take it off of? Well, in all reality, I would not have been mad if someone said this level to fulfill, because this is a demand zone. This is in discounted price. If I pull my fib from the low to the high, we can see that's around the 71, 78 level. But when we have strong, violent moves like this, and this happened at 9 o'clock in the morning Eastern time, so very strong New York session move. This may have been during NFP or something, actually, if I do recall correctly. Very, very strong move. We oftentimes, when strong moves occur in the market, we oftentimes don't see deep pullbacks because the momentum is very strong. The law of effort, if you guys know what the law of effort is, when momentum is very strong, the effort is so strong to one direction, usually the effort isn't as strong nearly as much in the opposite direction before another effort momentum push to the upside occurs again in this example. So what we can do is when these large imbalances occur, we can look for the mean threshold, because oftentimes the institutions will come and fill or offer in this case selling to traders at the mean threshold at least. That's the 50%. So we can simply pull a fib, and this is a trade that we actually took back in 2020 from this wick to that wick, and place our buy trade right there at the 50%. And then we would have had a beautiful wick entry and a continuation. Same thing goes here, right? So a lot of imbalance between this wick and this wick, and we know momentum is quite strong. You could try to take it off to fulfill. That's a completely valid region. But when moves are very, very strong, consisting of many bullish candles in a row, and we're highly, volatile, especially at this point in time, when COVID came out, the dollar absolutely died. And when we pushed up with Euro USD, very small retracements and large continuations, very volatile continuations, we can take these trades off of the 50%. That's exactly where we came into here. So just stuff like that we can start to utilize. So now that you understand what an imbalance is, why it forms, how to trade both the mean threshold and the fulfill, now you are able to take that information and apply it to your everyday trading. So guys, I hope you enjoyed this video. This was just a brief overview of what imbalances are, how they form, why they form, and how we can take advantage of them to produce not only high win rate trades, but very precise trades that we can have high risk to rewards on as well. So guys, I hope you have a great rest of your day. Thank you very much for tuning into this video. As always, if you have any questions, please feel free to let us know. Any of the team members here at Ariel know, and we'll be happy to help you in any capacity that we can. Guys, if you are interested in learning how we do this every single solitary day, breaking down the charts, top to bottom, A to Z, the whole shebang, and want to take your trading to a whole new level, and want to really become a consistently profitable, fully funded, full-time trader, if that is your goal, we would love to speak with you further. We want to work with those types of people because we want to take a very small amount of people to a very high level of status in their trading journey. So we were originally a signal service company. We don't do that anymore. We've created way too much dependency. We have limited and made very strict our selection process for accepting new members. But if you feel you have what it takes and have the right mindset and really want to make this a career and not just simply a hobby, go to our website, www.arielfxtrading.com, and book a free consultation with one of our fellow professional traders to see if you qualify for our program, to see if you are the right fit for us, so we can gauge your overall goals and provide an actionable plan specific to you if you do qualify for our program. So guys, check that out. It's really awesome. People are loving it, and it's something that I truly deeply enjoy as well, working with you all. So thank you guys so much. Have a great rest of your day. Have a great weekend. Happy trading.